of adopting distributed ledger technology for existing business processes and new business processes. Before I begin, I want to thank the panelists for taking the time today to come here and speak with us and share their insights. I'm honored to moderate a panel comprised of these industry experts. They're deep thinkers and, interestingly, have differing opinions on certain things, which I hope will make for a fruitful discussion. I disagree. By way of background and introduction, Kevin Werbach, sitting immediately to my right, is a professor of legal studies and business ethics at the Wharton School at the University of Pennsylvania. Kevin is an expert of emerging technology and served on the Obama administration's presidential transition team. He founded the Supernova consulting firm and helped develop the U.S. approach to internet policy during the Clinton administration. Additionally, Kevin is an accomplished writer, having published several books, one of which on blockchain, entitled The Blockchain and the New Architecture of Trust. To Kevin's right is Chris Ferris. Chris is an IBM fellow and is the CTO of Open Technology for IBM. Chris has the responsibility for setting the strategy and overseeing the execution of IBM's strategic open source and standards initiatives. He represents IBM on the Hyperledger Technical Steering Committee and is a maintainer of the Hyperledger Fabric project. And last but not least, Todd McDonald. Todd is a co-founder and head of product and marketing for R3. In that current role, Todd is responsible for R3's product and long-term marketing strategy. Todd served on the Hyperledger governing board and as a patron board member for the Global Digital Finance, GDF, industry body, a group that is focused on developing industry code of conduct to drive sustainable crypto asset innovation and works on the cross-platform token taxonomy initiative. Prior to his work at R3, Todd was with Standard Chartered Bank for 14 years, where he most recently served as managing director. Before we get the Q&A kicked off, I want to frame this panel. Most of the questions in the discussion we're about to have circle around three topics: data systems, governance, current use cases for businesses within the financial markets, and identity and privacy. After the panel concludes, we are open, or we have allocated time for questions from the audience, so please feel free to submit questions during this panel. If time permitting, we are able to. I have prepared a lightning round of questions for the group. All right, so that being said, perhaps we should do a little bit of level setting. So Chris, I'm looking to you. Can you explain the governance structures of various DLT systems? And what I'm envisioning is permissionless systems, permissioned private systems, and permissioned public systems. And most importantly, can you share with us your view of the risks and benefits inherent in each?
Sure, thanks, Scott. And again, thanks for inviting me to the panel. It's quite an honor. I don't think I've been in the SEC building before, so this is a first for me anyway.
Welcome.
So yeah, let's talk about that, because I listened. This was really, I think it was fascinating today. Usually I'm dealing with bits and bytes. This was really, I think, eye-opening for me from a technology perspective, understanding how the systems are being used or abused. But a lot of what I heard this morning was about public blockchain, typically permissionless blockchain like Bitcoin or Ethereum, some of the derivatives. Permissionless system, basically, anybody can participate, anybody can stand up a node. You don't know where that's been, right? There's basically total anonymity, unless, of course, you choose to reveal, who you are behind a given key. And so you have to build on top of that all kinds of structures for, if you wanted to do KYC and AML kind of identity, you'd have to layer that on top of the system. The system doesn't provide for it natively. And then, of course, the other thing is you're sort of the system itself is the software, right? That's the governance, is the software itself. And there's not really a whole lot of governance over Bitcoin or even Ethereum. Ethereum, yeah, there's a spec and they try and adhere to the spec. But by and large, it's basically the committers of the open source project for Bitcoin or some of the derivatives and or the Ethereum clients that are defining the governance of that technology. So Ethereum, for instance, is evolving away from proof of work because it's very expensive to mine the Ether, and they're moving to proof of stake. But that's taken, what, more than 2 years? I think it's almost 3 years now that they've been.
It's always 6 months away.
Yeah, 2 weeks, right? 2 weeks. And so they're in the process of trying to change the way the consensus is done, which could have significant ramifications to a lot of, what you were all talking about here this morning. So that's permissionless. And so it's, again, basically anonymity. You don't know where it's been. The smart contracts run on every node, right? Bitcoin has smart contracts too, but they're just very simple ones. But they have to run on every node. And so the other thing that you have to factor into all of this is, and we talked a little bit about this morning, finality, right? You have probabilistic finality, which means you have to have more than 51% of the network has had to execute the transaction, commit it to the ledger before it's final or committed. And so you can only determine that probabilistically. How long does it take for, the blocks to propagate through the network? How many blocks back do we have to go before reasonably you wouldn't have a situation where the blockchain might be undone? And then you have, I think, the next sort of evolution of that, and what a lot of us are working on, Todd, and with R3 Corda, the work that we're doing in Hyperledger around Hyperledger Fabric, the sort of the permissioned versions of Ethereum like Quorum, take a different approach, right? Rather than using proof of work to do consensus, we're building essentially a system that's going to have some additional form of governance around it. So whether that's a consortium that's operating under some sort of a legal agreement, some sort of a legal context, a framework, I should say, and all the participants are going to be known to one another. So the distinction here is if you're operating in the permissionless context, every node is operated by you don't know who. So you can't trust it at all. That's the whole notion of being totally decentralized, but there's also, and they say, well, you have trust because of the system and no, actually, you don't actually have trust. But you can get trust when you're dealing with people that you know, right? So, you may consider that all the securities firms are basically competing with one another, but they know each other. And I think, so there's a certain degree of trust that you can establish by the fact that you're operating under a legal framework, and so if there is a bad actor, you can deal with that through the typical legal processes and regulatory processes. And so you can have a closed system or partially open, again, but it's basically you vote people on the island, right? So you're operating nodes, everybody knows who's operating a node, they're identifiable. All of the transactions are identifiable to a particular party that's involved in the blockchain. When you have that additional layer of trust or governance around the network itself, you don't have to have something as exotic as proof of work or even proof of stake as a means of achieving consensus. You can rely on more traditional sort of crash fault tolerant or even Byzantine fault tolerant algorithms that don't involve the expense that we have to go through when we're mining Bitcoin or Ether and doing a proof of work computation. And so you can rely on more traditional, these algorithms have been around for 20 plus years. They're well understood. They're thoroughly debugged in terms of the protocol itself. And so we can rely on those as opposed to having to resort to something like proof of work. And then you have the sort of the semi-private, which is basically, again, it's a permission system, but people can join, can get an identifier, and be identified. So whether you have a system like Indy or some other self-sovereign identity kind of a system, you conceive of having that as the sort of the entree. You just have to be identified. That's the key thing, is that you're identified and identifiable in the system.
Can I jump in there for a second? I think that was a great description of the way the world looks today. This distinction between permissioned and public or permissionless blockchains has been in the lexicon for the last 4 or 5 years, and I think it's an important distinction. This is the last panel, so I'll be a little bit crazy and forward-looking, and I'll give the disclaimer: nothing I say represents the views of Satoshi Nakamoto or anyone claiming to be Satoshi Nakamoto. I would say 5 years from now, I don't think we're going to make that distinction that Chris did between public and permission, because I think there will be so many hybrids along the way. One issue is who can make transactions, who can be on the network. The other issue is who is verifying or validating transactions. And those don't necessarily have to be the same thing. So you mentioned Quorum, which is a fork of the public Ethereum code base, the Ethereum virtual machine, originally by JP Morgan, with a permission layer on top of it. There are other interesting experiments that involve using some sort of public consensus mechanism, whether it's proof of work or proof of stake, at the base layer for security, because at some level, having no central point of vulnerability, the idea of a public blockchain consensus system where you're not relying on trust in any particular actor, in some ways actually provides better security, and also the value of a public network where, like the internet, there's one common platform, potentially provides for a network effect of value. So, for example, there's a lot of work going on, mostly on Ethereum now, about what's called decentralized finance, DeFi, or open finance, where companies are creating different financial primitives, things like one company will create a stablecoin primitive, one company will create a lending primitive, some other kind of primitive that can plug in together, and it's easier to do that in an open environment. The kinds of applications Chris was talking about, where you've got a consortium of actors, so you've got, say, a syndicate that's syndicating a loan, it makes sense that those parties absolutely need and want to know each other. And the trade-off involved, the performance advantages and the other advantages you get of using those simpler kinds of consensus systems are absolutely worth it. My guess is that going forward, we're going to see a lot more things in the middle. Two other examples that are just starting up right now, and I'm not predicting that any of these in particular will succeed, but just we have to keep in mind how fast this technology in this world is moving. There are groups like Cosmos and Polkadot that have a vision of a kind of internet of blockchains, where you might have multiple different blockchains that have different characteristics, more permission, more private, or limited in other ways, but that again share the common consensus, share common security. And then there's experiments like Microsoft just announced something a couple weeks ago called ION, which is Identity Overlay Network, where they are creating a decentralized identity layer. And I know we'll talk more about identity, but essentially a permission-like identity system where it's using the Bitcoin blockchain, and I think ultimately other blockchains, but a public blockchain as basically the anchor representation, because again, they want this to be public and universal identity data, but the performance isn't possible on the Bitcoin blockchain itself. So again, I'm not suggesting anything said Chris is wrong, but I think going forward, we're going to see a lot more things that are really in the middle, taking advantage of these different approaches for what they need.
Can I disagree with Kevin, since it's the last panel of the day? We're going to make that disclaimer for every time we disagree.
It's two against one here, right?
No,
either way, however we do it. So.
We'll take a different tack. So let me preface the comment by saying I love Bitcoin. So I think Bitcoin's an incredible invention. I own some. Don't hit me with a wrench afterwards, not that much. I don't own very much Bitcoin. But if you think about what Kevin was saying around what he was describing was a permissioned system on top of a permissionless system. So Bitcoin was created for a very specific need. It was censorship-resistant digital cash, probably more like digital gold now. And it's serving that purpose very, very well. But as Chris said, in Bitcoin and some of the other systems like it, they view identity as a bug, not a feature. And it makes sense if you're trying to create a system that is censorship resistant, where anyone can join, no one gets in between two parties when they want to exchange value. That has uses, but when you think about what are the problems that, say, a large corporate enterprise is trying to solve? What's the problem that a large financial institution is trying to solve? Putting their system on top of a permissionless system, to me, doesn't make much sense, because all of technology is about trade-offs. And for blockchain technology, it's even more so. So the trade-offs to have that censorship resistance is the architecture and system that we have with Bitcoin. And the reason that Bitcoin is quote-unquote slow is not a choice. It's because of it has to be that way for what it's trying to achieve. So for enterprises to really tether back or to anchor back onto a permissionless chain seems like trying to architect something onto another platform when it was really designed for something else, which isn't any fault of Bitcoin. Because if you think of the two big things when we think about what is an enterprise trying to do, what are the things that they need, strong identity is definitely one. And the second, in echoing, is settlement finality. So probabilistic settlement has no place within capital markets.
Yeah, and I didn't mean to say that was the last of it. I was asked to sort of set the stage, right? So I totally agree with Kevin that 5 years from now, I think we're going to be seeing something a little bit more fluid in terms of the distinction between permissioned and permissionless and public and private. But I agree very much with Todd. And I think it's important to also appreciate that, in fact, most of the permissioned systems that are being built today are able to essentially form that network of networks that you described, the work we're doing in Hyperledger Fabric. Corda is essentially the same sort of notion. It's not a totally closed system, because you can have overlapping participation.
You can view, I think, there's a difference between strong identity. So open, it's not open or closed. You can have open networks with strong identity. I think that's a big thing, a big difference. So if you think of like this internet analogy, where sort of say permission systems aren't like the internet, I think it's actually quite the opposite, right? So you can have open networks, but with different architecture and different identity schemes in them.
That's right. That's right.
Thank you. We're gonna circle back to identity later, but Chris, I want to go back to you for a moment. I'm just curious. I know you're a big advocate for open source development, and some of the critiques you just made with respect to permissionless systems is related to the consensus mechanism, right, for content and security of the network. But I'm wondering if, with WebAssembly being more prolific, the programming languages are better understood by more developers globally. Will you foresee permissionless systems being developed in a more enhanced manner?
So, who knows what WebAssembly is? Anybody? Todd?
I didn't say EWASM. I was tempted.
So WebAssembly essentially is, how do I describe this? It's basically, it's an ability to compile any number of different languages down to a single set of operational bytecode. And that bytecode can run anywhere that there's a WASM interpreter, if you will. It's similar to what we have with Solidity and the Ethereum virtual machine, and essentially it has the same sort of operational characteristics. The difference is it can support a wide variety of more traditional programming languages. And so there's a number of efforts underway. There's a project at Hyperledger where I'm participating called Transact, that's going to be building a WASM-based smart contract processing engine and a coherent API. And the dream is, well, we can get to the point where we all are sharing the same smart contract processing capabilities. And then, to both Kevin's and Todd's point, we can think about the potential to have these sort of interacting and overlapping different technologies. But I would say it's not even the same consensus, it's with different consensus models and so forth, because I think that's fundamentally important. Todd mentioned that it's all about a trade-off, and I like to say that we're sort of trying to achieve 5 different things. We're trying to achieve consensus at scale, very large scale, with high performance, high throughput, and with low latency of confirmation, and all of that with privacy. And when you try and solve for those 5 different things, it's always trade-offs, right? So you're trading off how am I doing consensus in order to get better throughput versus, maybe you have to sacrifice some privacy, or maybe you have to sacrifice some latency and so forth. So there's always trade-offs. And I think to Kevin's point, the technology is evolving. We heard about Nightfall this morning. It's evolving so rapidly that, it's hard to even predict what it'll be like at the end of the year. And so it's going to be Mr. Toad's wild ride, I think, from here on out.
I think maybe is the open, you mentioned around open development, so an open source. So I think that's one of the hard things when you talk about permissionless. So open and open source, I think that has already been decided. All right. So open source is really table stakes for any blockchain platform. And if you think about the scale at which some of these want to operate, whether it is Bitcoin or whether it's the enterprise approaches, there is very large scale. There needs to be lots of eyeballs on it, and no one's going to trust the underlying crypto of the system you're running unless it's open source. Also, from an adoption perspective, it's incredibly important, not only for the users because they don't want to have a bait and switch later, but also for the developers. So from our perspective, from Corda, we've been open source for 3 years, and it's really because the lifeblood of any platform, especially a blockchain platform, is the developer community around it. So it has to be open source.
Yeah, if I could just throw in 2 things. One is that EY Nightfall technology is an example of a very enterprise-focused company releasing that technology on public Ethereum mainnet. So this opposition that necessarily traditional enterprises will be allergic to anything that's public blockchain, I don't think is necessarily true. And then the other point is, often really this is going to come back to this issue of governance, which Chris started with. And there also, we're seeing lots of, I would say at least experimentation on different structures. And some of it relates to this issue of open source. And I agree that I think generally speaking, open source is the better approach here. But there are some projects like Hedera Hashgraph and Algorand that have proprietary patented technologies where their argument is not that this is going to solve every problem, but if you want to have a public-like system where you can enforce governance, where you have the ability to say remotely turn off a node that's not compliant or that wants to fork and have some mechanism to prevent that, they can do it, they think, based on the license for the software. I certainly don't think that's going to be the winning approach broadly, and certainly things that are going to be widely used, just the proven benefit of open source that the other 2 panelists have talked about. I completely agree that with more eyes, all bugs are shallow. That's going to win out. But I think, again, we're still in a period here of a great deal of interesting, innovative experimentation. On the governance side, there are a number of public blockchain projects like Tezos and Decred and EOS, which have really novel mechanisms to use either token-based voting or some sort of arbitration system that's baked into the protocol. There are reasons for skepticism about any of those projects, any of those systems, but I think we need to let the tape run. And this comes back to what's been talked about in some of the early panels. It would certainly be nice and valuable for a lot of reasons to be able to resolve all these questions right now and say, okay, let's decide how DLT is going to be used in the financial system. But there's still a lot of uncertainty there. And there's some pieces of this that maybe can be done more quickly from a regulatory standpoint, but there's some of them that you don't want to make a decision based on what things look like today when they might change very dramatically tomorrow.
Yeah, I wanted to also touch on another point that I don't think was adequately expressed earlier. So we talked a little bit about smart contracts, and I think it's important to understand the distinction between the underlying framework or platform, if you will, whether it's Hyperledger Fabric or R3 Corda or Bitcoin or Ethereum, and the smart contracts. The governance of those is independent, right? The smart contract, in the context of something like Bitcoin, well, Bitcoin, the contract is the client to a certain degree. In Ethereum, though, you are writing a contract in Solidity or Viper, or one of the various Ethereum programming languages, compiling it down to bytecode, and you're running that in all of the nodes. But you only publish one contract, and there's a single owner for that contract. Now, you can create various exotic kind of schemes to sort of have multi-party signatures on that to make sure that it's only, that a number of people have had a chance to sort of review and approve it. But there's no real formal rules behind all of that. Again, the governance is in the code. Whereas with something like R3 Corda or with Fabric or even with Quorum, because it's a permission system, you can write it into the legal documentation for that particular consortium, if you will, that here's the rules. We're going to have, everybody gets a chance to review the software before it's deployed. We can audit it, we can do, we can debug it and so forth to make sure that we're all in agreement that this is the contract that we're going to be running with. You don't really get that, I think, with the public. So now, it's not to say that that won't happen. I'm just saying that today, without that sort of, the strong identity aspect of things, I think that's a function that's kind of missing.
No, and that's a great point. It's an easy transition because I wanted to ask Kevin about dispute resolution, and in particular in permissionless blockchains. Kevin, you have a great line in your book, which I'm going to try to paraphrase here, that disputes do not go away simply because a computer has self-executing code. I agree with that. And I was hoping you could walk us through what you think in either the near-term future and an optimal world, how does dispute resolution function between two parties, not on a governance of a protocol level, but between two parties to a transaction?
Well, for the reason I talked about before, I can't give one answer for that. What I will say is that a smart contract is a contract, a legal contract, if it meets the basic doctrinal requirements of a legal contract, things like mutual assent and consideration and capacity and so forth, which generally speaking, if we're talking about some counterparty agreement, it will. But at some level, this is not such a radical advance. Most derivatives transactions now use the master agreement, which is a set of very complex legal contracts, but basically designed to enable digital execution. So those trades happen based on the computers making determinations. It's just they've tightly specified enough that the situations where there are actually disputes that need to go to court are fairly rare. The difference with a smart contract is that the system is designed not to have that backstop of legal dispute resolution. It just executes the transaction as specified, and it's not designed with the notion that the parties can go into court and then reverse it, because it's true, on a public system, there is no mechanism automatically built in for, say, a court or some other agent to say, you win, you need to transfer this asset back in this direction. So that's the problem, and that's certainly why we've seen some incidents like, most famously, the Dow incident in 2016, where there's no mechanism. That was a case where it was very clear to everyone involved that there was a bug and that there was a theft, and even so, there was no mechanism short of forking all of Ethereum to redress that problem. But I'll come back to what I said before. That doesn't mean it's impossible to have any kind of dispute resolution system if you think about governance. So, for example, if you build into a smart contract some sort of arbitration backstop, simplest way is use a 2 of 3 key system with multi-signature or something like that. So each party has a key, and then the third key goes to a neutral arbitrator. So only if there's a dispute does the arbitrator break the tie. And the arbitrator might be a person, an organization, or maybe even some decentralized system that's using some tokenized mechanism to make judgments. It's possible to build that in, but certainly, to the point that the other two guys I think will probably emphasize once I stop talking, it's a lot easier to do that. If that's your primary concern, is how do we provide tight, clear, clean dispute resolution through a terrestrial legal system, sure, it's easier to do that if you are starting with defined identity and a permission system. But again, I think this is a moving target, and there's a lot of work going on these governance mechanisms, as well as on things outside of the legal system. How well audited are these contracts? How tight is the language in terms of what flexibility it gives you? Ethereum is designed to be Turing complete, so there's lots of different ways that there can be bugs or exploits or problems. Some of the other systems use languages that are more limited to avoid some of those problems. So again, I come back to what I said before. There certainly is a spectrum, and I'm not saying that there's not value on one end of the spectrum, but it's not absolutely either or, that either you have dispute resolution or you don't.
Well, I think public blockchains do have dispute resolution. It's called Twitter.
That's dispute.
Oh, sorry, it's just dispute.
It's dispute facilitation.
You mentioned, I think you mentioned ISDA before. So, and also, when we started in R3 2015-16, when we looked at what the problems to solve for one of the things, especially in the Ethereum community, is this code is law as a saying, and we took a different tack saying code is not law. It was a bit the opposite. So, and if you think of is there a master agreement, or in effect how markets work, which is already there's a trust minimization game. You don't eliminate trust, but you try to minimize it by credit lines and documentation and papering things. The ability for a smart contract to tie back to a legal agreement is actually quite powerful. And we specifically designed Corda so that the contract code refers to legal pros directly. Because things do happen, disputes come up, there's fat finger trades, whatever can occur. So there needs to be a mechanism to be able to point back to the legal world and the documentation. Number one, because that makes sense. Number two, if you think about how you try to implement certain technology and new market structure. So market structure, depending on whether it's amazing, cool blockchain technology or just any market structure change, it's all about a coordination game, and you have to coordinate within the existing system while you're also trying to enhance it and change it. So you have to fit into what's there while you're trying to improve it. And if you look at what's happening, what's interesting for me in being in the space for a while is that we get to come to buildings like this and work with organizations like the SEC, working with organizations like ISDA, which, derivatives lawyers that are actually excited about stuff. It's pretty incredible. So there's a lot of, I think, thoughtful innovation going on in the space.
And perhaps we can stay on the ISDA or on swaps and security-based swaps a little bit longer. Can you walk us through it just for context for the audience? I mean, when one of these transactions is consummated, that kicks off a myriad of workflows effectively. Not just the contractual rights and obligations of the parties, but then there are a whole host of ongoing calculations of the value of the transaction, the value of the collateral, and to the extent that there's a life cycle event to upsize or downsize the notional exposure. I mean, these are all a bunch of moving parts. So can you spend some time talking about how this is actually working in practice?
Sure. During the panel prep, Scott and I started talking about this, and he got extremely excited by this topic, which was refreshing. Hopefully, you'll all be excited as well. So we mentioned before, so ISDA's been doing a lot of work in this space, and they've been spearheading an industry initiative called the Common Domain Model for derivatives broadly, but if you look at the swaps market, there has been work going on around derivatives. I think Mark was mentioning the DTCC work earlier, which both IBM and R3 took part in, with the Trade Information Warehouse and CDS. And one of the challenges, I think, for any implementation is, can you come to a standard representation of a derivative contract in sort of the smart contract world? So can we, in effect, create an interest rate swap that is actually fit for purpose for a smart contract? And also, when I remember the first time sort of getting my head around how blockchains could work, it was a perfect fit for a derivatives contracts, for smart contract especially. So as Scott mentioned, the aspect of a bilateral, multilateral transaction is extremely well suited for a blockchain approach. With Corda, we look at things as a peer-to-peer paradigm. So especially with the markets, it maps quite well to that. Once you have, in effect, the trade that is struck, you can create that golden copy of a transaction on any blockchain protocol. That's really is what all of us are looking at, is how close to that point of execution you can create that golden source of a transaction. And obviously within a swaps contract, the amount of life cycle events that happen can be quite intense. Usually it's very, very simple, and especially as we start to standardize more, if there's standard in the SIM model is standardizing how you really measure sensitivities on a contract. The more standards you get to wrap around something, the easier it is to program it into a smart contract, which is really just an if-then statement, just replicated many, many times. So you can have counterparties agree that what I see is what you see on this, and you can move on to the next. Because as we all know, in dealing in markets, as soon as two counterparties agree to a trade, that's the last time they actually agree on anything until it settles. They have to always be calling and faxing and yelling at each other.
And you raised a good point towards the end there about what we know kind of as the Oracle problem. So the idea of getting information from the real world and getting it reflected on the blockchain, especially if it's going to cause the execution of a smart contract. So I'm hoping, Chris, you can take this, or Todd, maybe we go back to you regarding the swaps as an example, or some other like products that you're seeing, securities lending or repo markets. But how are enterprises addressing this issue? Or is it just not an issue to the extent that you're using a permissioned network?
No, it's still an issue. You have to. So one of the characteristics of smart contracts is they have to be deterministic. If you're operating on a public permissionless network that's doing proof of work, it has to be deterministic. It has to come up with the same answer every single time it executes, and it's executing thousands and thousands of times. In the context of something like R3 Corda or Hyperledger Fabric or even Quorum, it's not necessarily the case. However, the transactions still need to be somewhat deterministic. And so you want to make sure that you're getting information in that's going to be consistent. And so there's a number of things that are ongoing, and I know that I'm pretty sure that Todd and R3 are working with Intel, as is IBM and the folk in Hyperledger, leveraging some of the, in Intel's case it's SGX, but essentially leveraging a trusted execution environment to operate essentially an Oracle, a piece of software that's going to be publishing some stream of information that you can know that software cannot be tampered with, right? So it sort of extends beyond the blockchain, but again, it gives you that confidence that you've got the trusted source, and the trusted source can't be hacked.
And I think that it's very important for whatever we're constructing and building does integrate with existing infrastructure. So you mentioned before, whether it's the edges of a blockchain platform are always where the danger is. If you look at just Bitcoin, the trouble comes at the exchanges on the edges of the Bitcoin blockchain. It's not the blockchain itself is where the attack points are. And on the Oracle sort of issue, it's the same. How do you interact with the real world? But I guess maybe to talk about another type of use case and that Scott and I had been discussing previously. There's been a lot of talk today around digital assets and tokenization and tokens. And the way I like to think of it, there's kind of 2 or 3 different models for tokens. You have native tokens, especially something like Bitcoin, which is really the token is the value, and there really is as little trust as possible. It's a bearer instrument. There's also a lot of advantages to look at something like something that is an asset-backed token. So it's a token that is represented by an asset that is somewhere. That asset could still reside on a blockchain, or potentially can reside within a regulated custodian. I think it's quite important as well, and I think maybe it's a little bit different from the first approach with Kevin. I actually do think a lot of the fun stuff is going to come when we take sort of enterprise technology and the crypto world and we try and figure out where those two meet. And I think the token space has been an incredible inspiration for that, and also the decentralized finance movement. And so one of the projects that we're working on is something called High Quality Liquid Asset Exchange. And this is a company that's working with a regulated custodian, which is Clearstream. And they have tokenized, in effect, a basket of securities for SEC lending, where it's really addressing a problem, especially for European entities, where they don't understand. They have a regulation for high-quality liquid assets on their balance sheet, but since they have no idea what's on their balance sheet, they usually run about 150% of what they need, which is quite expensive for them. And they would like to find counterparts that they can more in real time be able to swap exposures so they can run much more efficiently. So this system was created combining new technology, combining legal constructs, so this is all papered up, combining an existing custodian and putting all this together with financial counterparts to solve a problem, to reduce balance sheet drag. And I think the interesting part is it's using the technology in the way to make it better and faster than it was previously. So they get better visibility of where they are with their balance sheet. But importantly, once the token is created from this basket of securities, the token can move around the system, and if it goes from me to Chris to Kevin, the ownership changes and is recognized as going from my balance sheet to the other balance sheet. And the regulator blesses that. But at the same time, the asset does not have to move from the custodian. It can still happily sit there. And even more interestingly, if there's a desire to swap out one of the securities that creates that basket, you don't have to call the token back and destroy and reissue. You can swap it out like for like, because you have someone like a Clearstream that is looking at that and saying that's okay, and they're in effect, they're signing that transaction and approving it. So it's that mix where you can have the existing financial world using new technology that's really interesting, because this tying back to the token side of things and the whole ICO and STO movement, there's one school of thought that there's no need to sort of integrate to the existing financial system. But I think what the last year and a half, especially with, say, utility tokens and security tokens have shown, is that if you want to reach institutional investors, you have to make your product fit into how institutional investors can purchase, custody, and value that asset. So the closer you can knit into the existing system while still preserving the benefits of the new technology, the better off you are.
Yeah, and that sort of, I wanted to just sort of touch a little bit on the trust and, sort of the integration with the existing systems. A lot of the early sort of hair on fire thinking in 2014, 15, and 16 was around, I'm going to get disrupted and everything's going to be decentralized, and DTCC and various other entities will just go away. Well, that's not happened, nor is it likely to happen, because the crypto itself doesn't necessarily lend any trust. I don't know if anybody's ever read Bruce Schneier's write-up on this particular topic, but he's basically making the case that there really isn't trust in Bitcoin. Trust it transcends what we need in just a piece of software. And so there's going to always be a need for regulators. There's going to be a need to have custodians. There's going to be a need to have exchanges. Those are all centralized by definition, right? So I think this sort of the next few years is going to be exactly that. It's not just the technology aspect of things that are going to be changing, but it's the integration of how does that integrate with the existing systems that we have today, and how are those systems accommodating the fact that we're dealing with blockchain?
Yeah, and I just have to jump in briefly because my book is called The Blockchain and the New Architecture of Trust, and this is really what it focuses on. And this is another illustration of something that's come up on the prior panels, which is that this is not a trustless technology, because there needs to be trust at some point. Trust is a willingness to act despite some vulnerability or uncertainty, and that's actually what we want. Really, what we're talking about here is two things. One is trust minimization, where there might be a problem in the trust that has to be reposed in a particular trusted third party with some of the traditional systems, where there might either be more efficiency or other benefits of not having to rely on that party for security. And also situations where there's a gap in trust, where actually expansion of trust is valuable, because traditionally multiple parties have to keep their own record of the same transaction. And with a blockchain, with a kind of shared source of truth, then it becomes possible for everyone to be basically trusted trusting the same ledger. So it doesn't eliminate the need for trust, but it does restructure it. And to get back to what we've been talking about, different kinds of implementations of these systems have slightly different architectures of trust. And this question at the edges about what happens in terms of getting things in and out of the ledger often becomes the central point where, again, you can have a very secure system on the network, but then what happens on the outside, often basically by shrinking the perimeter of trust, if you will, on the ledger, that problem gets worse. And I think that's part of what we saw with some of the fraud and so forth that happened with the ICO boom and in some of these other areas as well.
Todd, I want to just circle back on one of the points that you just made with respect to that balance sheet optimization. That was an interesting point, and there are clear beneficiaries, right, from a expense reduction, margin increasing perspective. But are there also like operational risk reduction as a result of that? And can you give us some sense of kind of how impactful that may be?
Yeah. So if you think of broadly speaking, there are three benefits to using blockchain technology. One is on the cost side. So if you think of both risk and cost on the operational side, two is, I think, on the capital relief, as we mentioned, being able to run a little more efficiently. And three is launching new products, reaching new customers. So on the first point, on the cost side, it's in effect the ability to have full auditability as well on the asset. You have a look back to where the asset has come from, who the issuer was, and the chain of ownership. In a transparent way on one degree, but on the other way to be able to sort of hide the privacy with some of the tech stuff that Chris had mentioned before. We won't bore you with more tech talk or acronyms, but there's a lot of different approaches where you can achieve both benefits. So there's reduced cost. I mean, the very first benefit we saw was around the elimination of reconciliation, as you can imagine. So that to me is sort of the baseline, and we're starting to see that. But I think importantly, the new technology, new implementations are always hard work. So it's a lot better, I think, to keep the interest and the energy when you're starting to introduce revenue streams as opposed to reducing costs for new products. And that's what we're starting actually to see now. And that's where I think digital assets and tokens have an amazing role to play, because it's not just about reconciliation, it's not just about cost savings. It's around being able to create new assets, being able to reach new markets and create new markets in a way either because it's cheaper or because we can start to construct assets in a more novel way. I think some of the panels mentioned it earlier today.
No, I know we're starting to run low on time, and I want to make sure we get to a couple of things, one of which is circling back to identity management and privacy, and they're interrelated concepts. Chris, can you get us kicked off on what are a couple of trends in this space with respect to utilizing distributed systems for identity management? And then if we could get some sense of how user control and authentication of their personal data may be optimized.
Right. So one of the things that's ongoing, I think there's sort of broad agreement in the industry about sort of where this is heading, is around the notion of self-sovereign identity. And there's a few different approaches that people are taking, but if I had to sort of nutshell it, we talked this morning about zero knowledge proofs, but basically that's exactly what we're talking about. It's a proof of some piece of information without necessarily revealing the information. When you think about whether it's GDPR or whatever, and you have to give out some personal information, when you give somebody a copy of it, they have a copy of it. You can't resend it, right? It doesn't self-destruct in 5 minutes after you listen to the cassette tape. But in the context of verifiable claims, is what we call them, essentially it's a zero knowledge proof that, and I'll give you the sort of the default use case here is, let's say you have daughter and she just turned, 21, she's going to go to the bar. The bouncer asks her for ID to check to make sure that she's old enough to go into the bar. But now she's given the bouncer her identity, her address, right, what she looks like. That's not necessarily the coolest thing. He could be photocopying it, whatever. He could, try and steal her identity, what have you. When realistically, all she really should have to do is to provide some sort of a claim, a proof that she's over 21. She didn't have to reveal her age, her date of birth, right? None of the personal identifying information has to necessarily be revealed. If we can get a zero knowledge proof where somebody can just check and say, is this person over 21? And the answer comes back, yes, right? So this is sort of where we're headed in the identity space, and the ability, whether you're going to use it for something a little bit more exotic like health information, or whether you're really just using it for AML, KYC kind of things about, is your income over $400,000 or whatever it is that somebody's trying to establish if you're wanting to set up and purchase some securities, where you're revealing the necessary information but without actually revealing the actual information itself.
And I want to take a step back and ask Kevin, philosophically, there's a tension between some of the privacy rights inherent in what Chris was just talking about, and then the need for robust AML, KYC, et cetera, for appropriate law enforcement. Talk a little bit about that tension and frankly, how this should pan out.
Sure. Well, the first point is this is a long-standing debate, the issue of whether there is a trade-off between security and privacy. And the short answer is no, not necessarily. And Chris just gave a great example that some of these systems, like these self-sovereign identity systems, leverage privacy-enhancing technologies like zero-knowledge proofs, but are actually more secure, because you're not having to leak and give out all that information, or have to have some repository, some actor that's going to aggregate together all the personal data, which then if that gets breached, if someone is able to get access to that data, everything is all out in the clear. These kinds of systems, because they are decentralized, because the user controls their own identity, actually in many ways can be both private and more secure. And similarly, again, some of the examples we've already heard about today about building privacy-enhancing zero-knowledge type systems to obscure trading information and identity are systems not designed to evade law enforcement, but designed either for security or for other benefits. I mean, there's a reason why I think it's more than half of all U.S. equity trades now are done in dark pools. And that's, again, not necessarily for money laundering purposes, but because there are advantages in not having it be in the clear who the counterparties are if you're making large institutional block trades. So I think the same is true here. The problem does come back, though, to some of these challenges like money laundering. And I think the starting point is it's not going to be a viable answer to say we just need to give up on law enforcement. Sagal Mandekar, who's the Assistant Secretary or Undersecretary of Treasury, oversees FinCEN and the money laundering enforcement, was at the Consensus Conference in New York and a number of other places recently, and is given, I think, very clear speeches, as she should, that this is very important. There are serious financial crime problems. There are serious sanctions problems. And it's just not going to be an acceptable answer to the US or the other major governments of the world that we need to give up on that. So then the question is, how do we ensure that those requirements get met? And in some ways it gets easier with some of these kinds of systems. So some of the permission systems do allow for this kind of KYC process to be built in directly. But there are a whole bunch of hard problems that need to get worked through. And that's really where we are now, and I know we're short on time. But for example, the traditional money laundering KYC process requires the regulated entity to disclose both the originating and the beneficiary, the terminating party. And with some blockchain systems, especially the public blockchain systems, it may not be possible to identify with certainty the recipient, because it's a database, it's a ledger, it's not a messaging system. unlike some of the permission systems. So that's a hard problem that needs to be worked through. There also are hard issues about things like right to be forgotten and some of these other rules under GDPR. I think these are solvable problems if we go through and identify, well, who are we talking about? What are they doing? What are the means by which they are regulated? Can we regulate the on-ramps and off-ramps? So again, if we can require KYC of the exchanges, then the fact that, say, the Bitcoin blockchain or the Ethereum blockchain doesn't have definitive personal identity may not be as much of a problem if people are gated when they go in and out of fiat. There was a report by a company called Bitwise recently that suggested that if you actually strip out the clearly fake volume, the vast majority of the major crypto exchanges actually are US-based and are subject to KYC type requirements, either as money service businesses or under the BIT license. Two big exceptions are Binance and Bitfinex, and those are major big exceptions, but it's a tractable problem, I think, over time if we work towards it.
Okay, we are literally on our last leg here, so I'm going to do the lightning round, and yeah, exactly. Everybody
we like this stuff too much. Sorry.
So I'm going to go down the line, starting with you, Todd. Prediction time.
Prediction. I predict that I won't predict anything correctly.
What's that?
Predicting.
So, predicting what are the biggest changes as a result of DLT in market structure over the next 5 years?
All right. So yeah, this is guaranteed to be incorrect, mostly incorrect, but we'll go for it. I think in 5 years, what I'm excited about at least, I'm excited about the aspect of the peer-to-peer aspect for markets and for market structure. So my background has spent about 15 years in foreign exchange, so I saw how a market could move more peer-to-peer and more electronic firsthand. That's why I don't do that job anymore. But if you think about what the trend of markets have been, it is to that, but we've kind of fallen over at the last mile. So I think what we'll see is a continued blurring between sort of private and public markets, so that hopefully getting the benefits of both without the risks of either. I think you'll start to see primary and secondary markets also come together. And I think some of the examples we've seen with ICOs is actually, if you squint and you kind of get rid of the scams, that's a really interesting coming together of primary and secondary markets. And I think overall we might start to unlock this peer-to-peer of those seeking capital and those looking to allocate capital being able to transact directly.
Thank you. Nice. Chris, same question.
So I'll take it from sort of more of a technology perspective and see where we're heading. I think, if I were to look out, and again, I like Todd, whatever I say, it's probably wrong. Although I'm probably almost always right. But but I think, and we're starting to see this now, is there's starting to be more and more of a push, because as everybody's running around rolling their own blockchain or DLT platform, there's going to be more and more pressure for getting these things to at least integrate with one another and be able to talk with one another, to be able to have hash time lock, atomic swaps of tokens from one to another. This trend is going to drive to more and more, if you will, commoditization and componentization of the various capabilities, to the point where I think then in the world that Kevin describes, it's likely that we're basically going to be taking this sort of Lego set, and we have a Millennium Falcon here, and we're going to build a T-Rex, but it's from the same set of pieces. And I think that's essentially where we're heading. And because it's open source, I think we're going to have a better opportunity for us to be able to achieve that. And I think I see, as did Kevin suggest, that there's going to be a blurring of the distinction between public and or permissionless and permissioned, and public and private over that time period.
Thank you. And Kevin, you already kind of alluded to your future vision, so I'll slightly change the question. What does the world look like from this world look like to the extent that from a policy perspective we get things right versus get things wrong?
Yeah, I think about this a lot because, as you heard in the bio, I was at the Federal Communications Commission in the 1990s when we were doing early internet policy, and I do think, looking back, had we and the other parts of the U.S. government that were working on these issues not taken the approach that we did, which was an approach very much encouraging the development of the technology, engaging the industry very directly, and being focused on the potential of the innovation. Had we not done that, I don't think we would have gotten the internet that we got. I think sooner or later there would have been internetworking. I don't think it would have been as open, it wouldn't have been as fast, and the US wouldn't have reaped the benefits as much. And I will say, in some ways this is similar, but in some ways the context is different today. And like a lot of the people on the earlier panels, I will say the SEC is a very fine regulatory agency that's really doing an incredible job under difficult circumstances, because the agency is constrained by the statute as well as many other things. I always used to hate the SEC because when I worked at the FCC, if you say FCC fast, it sounds like SEC. And I would tell people where I worked, and they say, "Oh, I have a question about exchange regulation." I would say, "No, that's the SEC, not where I am." But now being here at the SEC, I'll say the difference from now and 20 years ago is 20 years ago, the US was basically the only game in town. And what we decided really determined the fate of the technology. This is now a global phenomenon if we talk about blockchain and DLT. The US is in a very strong position, partly because of the innovation ecosystem we have here in terms of the technology, and partly because of the place that we occupy in the global financial system. That is not guaranteed to remain the case indefinitely. And I do think that if we don't get it right from a public policy perspective here, my bet would be not that it doesn't happen, but that it happens somewhere else. And not just it happens somewhere else, that this interesting sidelight, this kind of new area is outside the US. But I think in time, 20 years time frame, we're talking about reconstituting the base platform of the whole financial system. And if we don't get it right, then I think the role that the US occupies, which is so valuable as being really a central, if not the central, global financial hub, I don't think that's guaranteed to be the case on that time frame. So I think this is tremendously important, and I know many people at this agency and other agencies are working very hard, but I think the stakes are really high.
Thank you for that. Well, I want to thank you all. This has been extremely informative, and I appreciate your insights and your time. So thank you.
Thank you.
Thank you. I'm going to be brief because it's Friday afternoon. I know you guys are anxious to get out of here. I hope you found that these panels were as interesting and insightful and informative as I have today. If I tried to encapsulate everything that was said today, I would not do it justice. So I'll just try to give a few highlights. Panel 1, we learned that if you're going to use an ICO to raise funds to build a business, you're probably conducting activity that's securities related. There are ways to register, there are ways to be exempt from registration, and there are ways to issue digital assets that are not securities. We encourage you to read our framework, we encourage you to seek the advice of counsel, and we encourage you to come talk to us if you have questions beyond that. We learned that there are important issues around disclosure, and we seek your input on what disclosure should be. And those who are issuing digital assets, whether or not they are securities or non-securities, disclosure is still important because you're selling something to someone, and people should get full information about what they're buying. We also learned that the federal securities laws are just as complex to computer scientists as coding smart contracts and Solidity are to regulators. So we need to translate between each other. We need to learn to communicate better, and I think we're on a good path to do that. In panel 2, we learned about market structures and how they vary, how they present different risks and different challenges to regulators. We learned that the technology is rapidly changing and that it's very unpredictable. We learned that custody is not a dessert. No, it's actually a key issue for us, and no pun intended there. We also learned that everybody on panel 2 loves the SEC, and we appreciate that. Panel 3, we talked about the fiduciary duties that really adhere to investment management space and how that overlies all the issues that are kind of we're grappling with in that space. Dahlia Blas and the division put out a really comprehensive letter, or 2 letters actually, asking for input on things like custody, manipulation, liquidity, valuation, redemption creation, striking the NAV. All those things are things that we invite your input in, and we encourage you to submit things to us, and we can publish those on the website unless you'd like them to remain confidential. Let's see. We learned that SOC 1 and SOC 2 are not clothing that helps you figure out what feet you're using. And rather, these things relate to important controls around custody, again, not a dessert. And then in panel 4, we learned about public and private blockchains, important experimentations going on, a lot of learning going on in both sides, especially around the questions of identity and governance and dispute resolution. We also learned that nothing excites the crowd on a Friday afternoon quite like a swaps contracts discussion. I'm just trying to add some levity here because we've talked about very complicated issues during the day, very complex and interesting. And hopefully it's clear from these discussions that our staff is highly motivated to engage with each other, but also to engage with you, the innovators, to figure out the answers to these really tough questions. Today's theme, simply put, your regulators are crowdsourcing your input. So we hope you contribute to our efforts to bring about beneficial financial technological advances. Before we go, I promise this will be brief. I want to thank the folks who worked tirelessly to bring about this forum. Making something like this happen is really difficult and takes a long time, a lot of work. So I'd like to thank the members of the Division of Corporation Finance Business Management Office, Virginia Schoenauer, Michelle Cooper, Jeff Gunsteins, Tarita McCleary, Michael Cleary, and Eugene Panglos. Ryan White from the Office